don't often see, certainly in emerging markets. In Europe, you'll see it in Germany, Scandinavia, simply because of the risk profile and also partially because of tax considerations. It's less common, but it is seen. You have a conversion, sometimes a management agreement with an option after several years to potentially convert to a franchise. It's kind of a hybrid. And then there's always the tried and true, build it and they will come and I will run it myself. Many people often go into that thinking they've been to a few hotels and think it looks pretty easy. They will find out to their regret that it's not. That said, in today's world, with online sales and like, a properly developed hotel with people who have experience in the past that can develop a boutique niche and a brand and promote it through third-party distribution can be very, very successful. And often in emerging markets where you're the first mover in a city, that can be very successful without a brand. So let's start. I think,
Scott, if I may, there's one more category that probably sits one level above. I will own it and operate it myself, and that's a marketing affiliation tie-up.
the soft brands, yes.
Exactly. So not as rigid as a franchise, but you still get to be part of a system of some sort, and that would be a marketing affiliation. Something like leading hotels or a Best Western or a Preferred Hotels, things of that sort.
And then the standards are a little less rigid, but you have to tick certain boxes, including fire, life, safety, room size, but they won't be quite as rigid. And you're effectively just getting the distribution system. Exactly. But they usually have some allure to them, don't they?
Yes, I think they provide relatively low cost and less onerous way of getting international representation and some distribution for independent operators.
Let me ask the first question to Andrew. I touched on it. Typically in emerging markets, one will see the management agreement model, and that is due to a presumed lack of local experience and expertise in running a hotel. Does that hold true for the 57 countries of various cultures, various legal systems in development in Africa?
Simple answer is yes. Being a hotel operator, we view emerging markets in a pretty similar way, and typically, an emerging market, we will offer a management contract. As a market becomes more mature, you will then find operators will then start to offer franchise models, maybe even manchise models, which is a management model, and after a certain period of time it moves to an actual franchise. And then in the most developed markets, it then moves to actually leases. So in terms of the Africa context, you would find by far and large we are still at the management contract stage. Although I would say South Africa definitely would be in the lease, version stage. Yes.
And why is that?
There are a number of leases there already. I can tell you we at Mövenpick are now seriously looking at doing leases in South Africa as well. And the reason for that is the market is a mature market. It's a stable market. It is a market which also is developed where the institutions are there where they're looking to invest in. And they are one of the prime demand generators for lease. And then obviously it has the finance and the legal framework to support leases.
I mean, that's quite a compliment to the country's system, because
absolutely,
with the lease, the operator is coming on shore, it's setting up a business, it's running the hotel in its name with all the risks, but also all the attendant legal and compliance risks. And it can often, in an emerging market, can often be very, feeling very vulnerable out there, where you're the lone foreign party. But you're saying that you think the system is sophisticated enough to do that.
Yes. And as you said, just so our audience can understand the risk of a lease. We have 25 hotels in Europe, 22 are leases, of which 20 make money, very good money. One is break even, and one loses $500,000 a year. And the simple reason is because when we entered the market, what we thought the market would do, and this is the Berlin market. Unfortunately, a massive amount of supply came on, and we've been underwater on that lease for 10 years at $500,000 a year. So if you get it wrong as an operator, you can get it very badly wrong. There are other examples, I won't name operators, but typically when 2009 happened in Europe, there were, I can tell you, in 2009, 2010, out of our 22 leases, 20 lost money. We lost millions and millions of dollars over 2 years. Things came good, we're fine. But there were other operators who did leases who literally were close to bankruptcy and had to get in new investors in to basically save them. So if that can happen in a stable market in Europe, there is no way, as an operator, we're going to go and do a lease in anywhere in Africa unless we can be sure the market's going to be pretty stable. And we factor into our projections. We know every 10 years there's going to be really one bad year which we will lose money. So, we have to feel pretty comfortable if we do a lease in a market.
I'd like to just contrast that, if I may, with a different point of view. With the work that I've been doing with CityBlue hotels now, I think it brings into stark relief the difference in comfort levels that a local operator in Africa has with Africa versus an international operator, like I was myself and you are now, looking from the outside into Africa to do leases. So CityBlue's primary mode of growth is leases, and they'll do leases all over East Africa, they'll do leases all over Africa where the opportunities present themselves. Because they're a homegrown African company that understand these markets intimately. And the way they would look at it is, as you just pointed out, this can happen in Europe. So, why would we not do it in Africa? It can happen anywhere. The bad stuff can happen. There could be big global events that affect the entire market. But if you're sufficiently diversified across a continent that's as big and as diverse as Africa, then you probably have a better chance of surviving it than if you were in Europe, which is pretty much one basket.
I think that's a very, very valid point. It's about having to spread the risk. Yeah. And obviously the risk profile for an international operator versus a local African-based group, there is different.
That's the key. You're not public in your local African company. You're much more nimble than the big boys. Ramzy, I mean, your group is it's a foreign company that is asset heavy and very Africa heavy.
Correct. So we do things a bit differently. We don't do leases. When we go into a country, we go full in. That's what we've been doing in Africa. We have different partnerships. We operate 25 hotels in 7 African countries that we own. So we're actually investors.
The majority owner.
The majority of them. Yeah. So we took the approach, and we did the same in Europe with Tivoli, the acquisition of the portfolio of 12 hotels. So we take the view that if we want to grow in a continent, and Africa is a huge continent, we'd rather be on the ground. The same, we were talking about taking the risks. I think we've been taking risks in South Africa, and that today is paying off. So we're seeing that our investment in Africa is now growing into giving comfort and security to the potential owners that are coming to us for HMA deals. So we're now into an HMA mode. We've invested a lot of money in Africa, and we see it really paying off by people coming to us, whether for Elwana or for Avani's or for Anantara, our core brands, because of the fact that we've been successful operators and actually really embracing the market. I mean, when you're the owner of a hotel, you're not only suggesting to hire the director of finance or the general manager. All the employees are on your payroll. And that makes a complete different setup where with other international operators who basically places 2 or 3 key people in the hotel, and then all the rest are on the owner's payroll. So I think our approach...
Typically the key people are on the
It depends,
payroll,
yeah, usually. But I mean,
they take their
when you have 200, 300 people on your payroll, as an owner-operator, the view changes. So we do management contracts. We've been looking at some M&A deals. We'll be looking at strategic M&A deals. But we're seeing most of our new projects in Africa are on the HMA side.
Let me ask this, this assumption that an emerging market lacks the local expertise for a franchise, and you need to do an HMA, although you two are different. Is that offset somewhat by the consolidation and the race for growth by the big operators, and that perhaps they can't source the proper staff to operate a hotel, and specifically staff with local knowledge and experience and expertise, that they really can't staff the hotel with a good GM finance director? And that might suggest, well, let's franchise with a third-party, unbranded third-party operator who has local people with a history of local experience in running a hotel.
I'll have a go at that then.
All right.
We don't do franchise ourselves. It's something which we have talked about internally, and something which would we do in the future? Possibly, we may, but let's wait and see. But in terms of Africa and franchising, from speaking to my colleagues, I think, the market's not ready for franchising. What does that mean? It means we find it difficult to get associates to come and work in our hotels and train them up. So if the large operators find that a challenge, then a franchisee is going to find the same issues too. And by giving a franchise, you're entrusting your brand to that franchisee. And at the end of the day, the most important thing to us operators is our brand. So you will find that franchises will be offered only to those owners who have managed hotels, or who have or who we have managed their hotels for a period of time, and there's a strong relationship and trust formed before.
Well, this is my point. You've mentioned that it might be difficult to recruit good people to send them to some of these outlying regions.
Yep.
Which means what you're going to do is not find an experienced GM, you're going to find someone who's an assistant GM and say, this is your opportunity if you move there for 3 years. And that can't be an ideal solution. Would not a better solution be, I look around, I see a good GM at a branded hotel up the street, I offer him a night's package, him and a few others, bring them in, and then get a franchise. So I have experienced personnel with local knowledge, and I've got a brand and a distribution system.
Scott, really simple answer. We do that anyway. Okay, whenever we open hotels, of course we would like to employ from within. We want to give our people the chance to grow up. If you want to be a first-time GM, you know where you start. You start in the place furthest away, and you learn your stripes and you move up. That's how it works. Fact. If we are in an area where there's a proven GM who has a great track record, or proven EAM, of course, sometimes it's better to attract that one to come and work in the hotel. So we do that anyway. In relation to a franchise, yes, if you have a great GM, as you said, from next door who comes in, and the team, the problem with a franchise is he'll leave after 3 years, then what happens? You've got a franchise for 20 years. And that's the risk factor.
Yeah, just to point out to potential owners or investors, it's not that the operators don't want to do the franchise model. You know, the franchise model for any operator, and take the big guys in the US, it's a cash machine. You know, you don't take the risk of managing the hotel. You're basically taking top line revenues, 5%, 4%, whatever the royalty fee is, and that's it, and you go away. Whereas a management contract, you'll take less on the top line, and you'll need to justify your fees on the bottom line, and that's why it's called incentive fee. So there's much more work. Just to be clear, you know, the franchise model for any company is great. However, in Africa, unfortunately, we still don't have the structure to be able to do franchises, and especially when you're talking about premium brands, like, you know, upper upscale brands. That's very difficult for an international company to give, you know, the jewel brand that they have to an operator that might put the brand down. At the end of the day, you know, any hotel operator, the value of a company is the brand well, the brand awareness. And the last thing that any operator wants to see is, you know, someone going to a hotel and saying, what's going on? That's not an ex-hotel. You know, the standards are so low, and the image of the brand is not good. So I think franchise is a great model. However, in some countries, it doesn't work.
I think it's evolving, because there was a time when, you know, I've sat on panels like this and said the reason we want franchises, we don't have competent third parties to be able to trust our brands with. I think that's changed. I look around the room here and I see Andrew Rogers here from AHA, I see Bani Haddad from AHIF, who are all fantastic operators who have all the skills and expertise and the African knowledge that you would need, and I'm sure there are many others. So that thing is evolving, and I think, I suspect you will start seeing over the next few years many more of the international players being a lot more open with franchising than they have been in the past.
With the third party?
With third-party operators.
I mean, I worked for 20-some years in Russia, and Interstate, which is third-party manager, they brought Marriott, they brought Hilton, and they brought Holiday Inn to the country. And it was, so you had a franchise system with a third-party manager in Interstate that had to deal with the country risk, the bureaucracy, the tax laws, dealing with an owner that spoke very little English, and the Interstate guys spoke very little Russian, if at all. And it worked out immensely well, and they were able to consolidate a number of hotels and get about a dozen hotels together, and the economies of scale they were able to generate with accounting, finance, sales, even with different brands, was phenomenal. And they were, I remember speaking with a guy, he goes, I'm kind of getting embarrassed, we're over 72% GOP. I've got to go spend some money. It was just a cash cow because of the amazing savings, and it was an easy entry for these big brands until the country got a little more established. You had the staffing and a little more stability in the market. So how important would you say is to the operator's success in a management structure of having a good existing infrastructure and base in the region, not just for these economies of scale, but just for knowing the markets? And what do you have? Obviously, you have quite a lot.
Yeah, I mean, we have several main hubs in Africa. We have a big office in Joburg. We have another one in Nairobi, where we have operation and sales and marketing, all the departments. So and you know, again, we've seen a lot of complexities operating in Africa, things that you would not be confronted in other countries or other continents. And I think it's key. You know, you need to be on the ground. You need to know your market. You need to know your suppliers. You need to know, you know, when the electricity is off, how to react. You know, if there's issues. So Africa is actually a very interesting continent in terms of reactivity. And I think for a company like ours, you know, we're still a big company. However, you need to be very fast and active and proactive in the African countries where we operate, because things move so quickly. And when you have international travelers, they won't admit the fact that there's no water in your room, or You know, you need to play around with the complexities of operating in Africa. And I think being on the ground is definitely key, and it has paid, again, you know, for us, it came with a cost of investment. However, today we have, you know, a lot of growth, and mainly on HMAs, because we've been proving, and we have a good track record.
So you've used this experience of owning and operating that now you're confident that you can go out and
the good thing also, you know, when you acquire hotels, when we acquired a couple of years ago, you also acquire some talents. You know, you need to also understand that there are talents in Africa. There are people who knows the market, who can get their head around some blocks, and we're trying to grow them as well at the same time. And those people now today are moving from our hotels to other countries in Africa, exporting the knowledge that they have.
Are there any questions from the audience?
Thank you, Scott. My question is to Andrew, and it's just in relation to the lease portfolio you were talking about with Mövenpick. How do you value a successful portfolio of leases in your business? So do you look at, is lease length important? Is EBITDA important? What are the factors that determine how you do that?
Wow, that's not an easy one to answer in a minute. I think the most important one is our lease coverage ratio, right? So basically, it's the percentage of the rent that we would pay to the owner as a percentage of total revenue. You know, and typically in Europe, we don't like to see that exceed more than 21%. We like to see it hover around 18%. We do go as high as 23%. That's ours. Obviously, other operators have different ratios. The other key issue we look at is, you know, what type of lease is it? There is a fixed rent lease. There is a floating rent, or a variable rent, or a hybrid where there's a portion of fixed and actual variable too. So all these things come into play. And the one other key issue is the coverage ratios, which we use, you know, and typically in Europe, mainland Europe, they tend to range between 1.2 and 1.5. So they are the typical things that we would look at.
What would you, with a lease, how would you fix the currency where you have devaluing currencies? Would it be
very simple.
A dollar-based?
It's in the local currency.
Fixed the contract in local currency, or US dollars convertible?
No, everything is in the local currency. Yep.
Sorry, one other question is, what's the typical length of the lease that you negotiate?
Sure. For us, it's typically 20 or 25 years.
Any other questions at the moment? All right, I'll be a bit provocative. I would make the case that, and I remember one of my mentors in the industry telling me, again, he was third-party manager, that the big brands manage their brand. I report to their brand. They're responsible for their brand. I report to the owner, particularly with consolidation and the focus on growth, the focus on brands. I mean, how can you really manage a hotel when you provide two people? You provide a general manager, you provide a finance director, you make me as the owner employ them. How can you run a hotel that way? That's just...
Why you keep looking at me for all these tough ones? Ask these guys.
Well, I'm asking him. You were with one of the big
ones.
Come on.
Are you asking me? Okay, all right, well, I'll take a crack at it.
CityBlue hat comes off.
Okay.
Former Starwood comes
on. Look, first of all, I think it's unfair to say it's three people, because, as you know, through the course of the management contract, the owner will assign the right to control all of the staff of the hotel to the operator. So while technically there may be 2 or 3 or 1 person that the operator has brought, in reality and in practice, it's all of the staff of the hotel that are working for the operator and in accordance with their standards and guidelines and so on and so forth. So I think yes, there is the technicality of the 2 people, but I don't think that's necessarily how it translates. I also think that all of the considerations we talked about having local knowledge and having the right people in the assets, everybody's aware of, including the big operators, the small operators, the regional players, the national players. They're all aware of it. And those have now become almost fundamental baseline requirements to have a successful hotel operation. And everybody who wants to be even reasonably successful needs to have ticked those boxes. You don't get out of the gate without that. Does that answer your question?
Partially. I'm still not convinced. I think, what would be when you come in, I guess, not you, Ramzy, but look at what model you think of offering for a brand, what are the factors you're looking at, country by country? If you were considering a franchise versus a management versus a lease?
For me, it's really simple. We only have one option, and that is management. Although South Africa, we might start looking at leases. So it's a bit, I don't really have an answer for that because it's pretty simple for us.
So, I mean, it's going to be probably the scale of the hotel, the higher scale. You're not going to do franchise, but your local expertise, country.
I could answer, I mean, even though we don't do franchise, but from my previous life, I think first it's looking at the partner, who's the owner, if he has any track record in terms of developing hotels, operating hotels, and who's going to be managing the hotel, so the third-party operator, the person that's in between the brand and the ownership. And that's key for any operator. So they will screen, the owner, screen who's going to run the brand. That's number one. And then, of course, the location, the brand itself. Many operators will not franchise their luxury brands, and that's a fact. Some of them might, but I mean, at my time, the luxury brands are not really for franchise. So then it eliminates some brands. And then third one would be the country, of course. There's some countries, maybe due to tax regulations, wouldn't make sense to make a franchise. Maybe the operator will have a lot of royalty fees and income tax to pay on the fees that it might be doing on the franchise model. Whereas the HMA, you can play around on revenues and profit depending on where do you allocate them. So, yeah, that would be it, I think.
We're kind of touching on HR questions here, but I imagine part of the decision which model we use is going back to talent and personnel. With the hotels you have, how dependent are you on importing expatriate staff, and where are we on the scale of localizing, including at the senior positions, GM, finance director in CityBlue hotels, Anantara and Mövenpick? Sure.
For Mövenpick, we've got 12 hotels in Egypt, all are Egyptians, 100% from GM down. But we first operated a hotel in Egypt in 1973. So,
and most of those are bred through the system, or picked from elsewhere? Through some international operators.
100%. In Morocco, we are, apart from one GM, they're all local GMs as well, and local DOSMs and department heads too. For us, we are probably a little bit, dare I say, more flexible than many of our actual competitors. Because we tend, when you say expats, there are different levels of expats. If you look at the proper expat, a European and then your next level of expat down may be, an Indian or an Egyptian or whatever, and then you come down to another level of expat as well before you get to the local hires. What we tend to have is, many of our hotels, when you look at the top level expats, we probably only have two. It's usually the GM and the chef. Then once you come down to the next level, financial controller, the DOSM, that's usually local expats or regional expats, but they not on a full expat actual package. So you manage it through many ways.
And Ramzy, how about you? You're at the luxury end, pretty much.
Yeah, for our African operation, we spend a lot of money on people, so we train local expertise. We fly in some technical people, like for example, we're one of the largest spa operators in the world in our hotels, so we fly in some technical people that you can't really find local expertise for. And that could be the spa operation, some specific, again, the culinary food, bringing Asian food to the African countries, some specific expertise. However, mainly is local expertise. So we invest in our people. Now you have expats from a country to another, but still African countries. So, you have some expertise that you find in South Africa that you don't find in Tanzania or Kenya, so moving around, but it remains mainly African people.
And Neil, with CityBlue?
CityBlue, as I said earlier on, is an entirely African company and group, and so I think I'm fair in saying that 100% of its management team today are from within the continent. And that extends even to the founder and to the shareholders of the company. So up until now, it's been entirely African. And I think that's the intent, is to keep it an African company with African roots and African aspirations.
And are these people who've worked in international hotels elsewhere?
Correct.
And then you're...
Correct. From within Africa.
Obviously, it's much cheaper if you're not importing an expatriate on an expat package. And certainly any of you who are developing hotels, when you're putting the management contract together, there should be a commitment over time to localize. And you may even put a ratio of that, either in numbers of staff and time. You can always say no if it's not viable, but certainly that it's in both parties' interest to localize as quickly as possible.
I think there was a time when there was a big gap in the cost side of it that you were mentioning. I think that is probably normalizing now a little bit more. If you want to get good qualified people within Africa, you pay them well. And that's the only way you're going to get the best people. So I think that gap has probably shrunk than it used to be maybe 5 or 10 years ago. But there's a more important angle to it, and that is the local expertise. It's people who understand how to operate in Africa, what the challenges are and how to deal with them, who are acclimatized already to the environment, to the work style, to the various intricacies of operating in every different country in Africa, all of which are different to each other. So it just makes so much more sense to have people who have that expertise than to fly people in and parachute them in and then wait till they figure it out at someone else's expense.
And if they like it, and
Yes.
if their wife
Yes.
packs up and leaves the next week,
Right.
or their wife gets replaced by localization. And that's a thing. I come from Russia. It was you either should be very, very married or very, very single, and if you're somewhere in between, it's a bad situation. It's the truth. Do we have some more questions? Anywhere? We've got a couple. Bonnie, you're a third-party operator in this market. Give a little of your experience so far, right there.
Thank you. Yeah, so AHIF Hospitality, we're we currently have 5 projects under development in Africa as a third-party operator, and with 3 different brands, international brands. So I think first thing we need to do is to start changing the way we speak about operators. Operators are actually brands. And I laugh when people say, but Marriott is franchising, but 70% of the portfolio of Marriott is franchised. Probably 90% of the portfolio of IHG is franchised. So, to all the operators, let's relax, the brands. You were all initially franchise companies, right? Now, I don't know what you want me to say, but there are a lot of advantages for owners, developers, to have a third-party operator, and that's the reason why the model is so successful in the US and in Europe and Russia and other places. However, I do agree with Andrew and Ramzy and Neil on the upper upscale luxury. It's not something that's very common. And we're not doing it. We're mostly doing it on the mid-scale, budget, limited service for the time being.
How do you respond? You're the developer. You're making your pitch, and I say, well, I pay your fee, third-party operator fee, then I pay the franchise fee. The two combined are more than if I hired Andrew and Mövenpick to run the hotel. What's the value proposition there?
There's a nice video on our website which explains it, but I'll summarize it. So listen, very quickly, we all know how the management fees work. Basically, if I have to summarize it, three lines. Going bottom up, incentive fee, that's the same, whether you're paying it to the brand, if they're operating directly, or to a third-party operator, that's the same. Then you have the marketing and sales fee, reservation fee, that still goes to the brand under a franchise agreement. And the last one, which is the base fee, that's where we try to play with the base fee. We split it into 2, a base fee that comes to us as a third-party operator, and the second part goes for the brand as franchise fee. In a more mature market like the US or Europe, developers, owners are ready to pay more because it's a proven model. They know that they're gonna get much more flexibility on their contract, real performance tests, and higher returns typically. In this part of the world, we're committing to having basically same or below in terms of total fees to be paid for the time being until we open and we can have some study cases to show to our owners.
And you'll do a contract 5 years, 10 years?
Not 5 years, but
Right.
10 years definitely, yeah.
Whereas Starwood would be minimum 20?
Yes, in Starwood, and probably most of big international operators would do 20 plus, and CityBlue would do 10 plus.
10 plus? Yeah. Where do you get your people, your key people? Are they locals?
Depending on the country. So we're in some countries in Africa, specifically where they are all going to be local, and some others where the talent on the top level, GM level, lacks locally. It's either from another African country or Middle East, Europe. But the middle management and staff is all local.
Thank the panel. Thank you.
Thank you.